Have you ever heard people talk about index funds, ETFs, and mutual funds and just kind of nod along, wondering if they're all basically the same thing? Don't worry, you are not alone. And we're about to untangle this whole investing puzzle once and for all. So, ETF, mutual fund, index fund. If this alphabet soup of investing terms has your head spinning, you've come to the right place. By the end of this, you're going to know exactly what these are, how they're different, and honestly, why it really matters for your money.
So here's the game plan. First, we're going to define the core strategy. That's index investing. Then we'll look at the two main vehicles you use to do it. After that, we'll dive into the three key differences, and we'll wrap it all up by helping you figure out what might be the best fit for you.
All right, let's jump right in. The biggest hurdle to understanding all of this is the term index fund itself. But I promise, once you get this one core concept, everything else just snaps right into place.
Okay, so here is the secret. An index fund isn't really a thing you buy. It's a strategy you follow. Think of it like a recipe. The recipe says buy all the stocks in a big market index, like the S&P 500, and just hold on to them. It's called passive investing because you're not trying to be a genius and beat the market. You're just trying to be the market.
And this whole idea, it's famously backed by none other than Warren Buffett. The logic is just so simple, but it's powerful. Since most of the pros who get paid big bucks to pick stocks can't consistently beat the market average anyway, why would you pay them high fees to underperform? A passive index strategy lets you capture the market's return for a super low cost.
So if you remember one thing, make it this. An index fund is the strategy. It's the what. It's your decision to just passively track the market. Okay, so now that we know what we're doing, let's talk about how we do it.
So, if the index fund is our strategy, the what, we now need to talk about the how. And the tools you use to actually execute that strategy are mutual funds and exchange-traded funds, or as you know them, ETFs.
A great way to think about this is like having two different toolkits for the exact same job. Both mutual funds and ETFs can be used to build your index investing strategy, but they work in really different ways.
Now, at their core, they're both just baskets that hold hundreds, maybe even thousands of different stocks or bonds. You put your money in and they invest it for you. The real differences, the ones that matter to you, are in how they're built, how you buy them, and how you sell them.
So let's put these two head to head. Let's break down the three key differences that have the biggest impact on your portfolio and, your wallet. We're talking about how they trade, what they cost, and how they're taxed. First up is trading, and this one's a biggie. ETFs trade on an exchange just like a share of Apple or Tesla. Their price is bouncing around all day, and you can buy or sell them whenever the market's open. Mutual funds? Totally different. You can put your order in whenever you want, but it only gets executed at one single price for the entire day. And that price isn't calculated until after the market closes. Difference number two, cost. As you can see right here, passively managed funds, which is what most ETFs are, have average fees that are way lower than their actively managed cousins. Now that difference might look small, but trust me, over decades of investing, that can add up to tens, even hundreds of thousands of dollars that stay in your pocket, not someone else's.
But here's where it gets really interesting. While ETFs are usually cheaper, the fee war has gotten so crazy that some index mutual funds now have costs that are just rock bottom. Look at this one. This is a mutual fund, and its expense ratio is just 0.015%. That is 15 cents a year for every $1,000 you invest. I mean, come on, that's practically free.
And that brings us to our third and final difference, taxes. Now this one can get a little complex, but it's super important, especially if you're investing outside of a retirement account. The way an ETF is built gives it this really clever built-in advantage.
So it all comes down to what happens when other people sell their shares. With a mutual fund, if a bunch of people want their money back, the manager has to sell stocks inside the fund to get them that cash. Well, that sale can create a capital gains tax bill that gets passed on to everybody still in the fund. Yeah, even you. ETFs have this really slick workaround. Instead of selling stocks, they basically trade huge blocks of them directly with big institutions. This in-kind swap isn't a taxable event, and that protects you, the long-term investor, from getting hit with a surprise tax bill.
Okay, phew. So we've covered how they trade, what they cost, and how they're taxed. With all of that in mind, how in the world do you actually pick the right tool for the job you're trying to do?
Well, this table really boils it all down. Look, if your main goal is to just
automatically invest a certain amount every week or every month, that classic set it and forget it approach, a mutual fund can be a fantastic choice. But if you're investing in a regular brokerage account where you're sensitive to taxes, or you just want the flexibility to trade whenever you want, an ETF is almost always going to be the better tool for the job.
So there you have it. The mystery solved. An index fund is the strategy. A mutual fund or an ETF is the vehicle you use to drive that strategy. And just understanding that simple but powerful difference empowers you to make way smarter, more confident decisions with your money.
Hey, thanks so much for sticking with us. If you found this useful, do us a favor and hit that like and subscribe button for more explainers just like this one. We'll see you in the next one.